backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next to.
2015, real estate investment trusts and operating companies that own some of their own real estate became one of the top targets for activist hedge funds pushing M&A, REIT spinoffs, and sale-leaseback strategies. However, that strategy may be changing after Congress reached an agreement last year to approve a must-pass tax bill containing a provision prohibiting favorable tax-free treatment of REIT spinoffs. With tax-free REIT spinoffs essentially off the table, the focus by activists is shifting towards sale-leasebacks and some novel tax structures. Welcome to today's installment of Merger Talk. I'm Daniel Perez, Director of Business Strategy for Venue, Donnelley's virtual data room platform and end-to-end deal solution suite. Today I'm joined by Steven Goldberg, Managing Director and Head of R.W. Baird's Real Estate Investment Banking Group. So Steven, one of the top go-to strategies for activist hedge funds in recent years has been to push operating companies, particularly casinos, restaurant chains, and department stores, to spin off their real estate into a REIT. What impact do you think the measure approved by Congress will have on those transactions?
Well, essentially what Congress did was shut that opportunity off for most operating businesses. There are some exceptions, but things such as prisons, timber, restaurants, gaming companies, which are true operating businesses and historically have had the opportunity to spin out their real estate into a separate REIT, are no longer allowed to do that. From 2010 to 2015, there was 15 transactions done, about $22 billion in total enterprise value, again, for all sorts of businesses such as prisons and gaming. That will no longer be able to be completed, and they will have to look for other forms to monetize their real estate.
Activists also have another tool in their real estate monetization toolbox, and that is to press corporations to conduct sale-leasebacks, which often pushes corporations to use the cash from those transactions to finance stock buybacks or debt reduction. Going forward, do you think we're going to see more of these types of campaigns?
By definition, because of the new REIT rules, or really the eliminations of certain exclusions in the REIT rules, that's going to have to be a very large part of how certain businesses get value for their real estate. Unfortunately, a lot of corporate America owns a significant amount of real estate which gets very little value in the public markets. So through things like sale-leaseback, joint ventures, et al., there will be a ability to do that. You are starting to see that pretty regularly now. Bob Evans just recently did a $200 million sale-leaseback. Pinnacle Gaming selling a large portion of its real estate to a REIT. Time Fitness just sold a good portion of its real estate to another REIT. So the sale-leaseback and joint venture strategy is not necessarily a new way, but probably a more active way for them to monetize their real estate while still gaining control over it for a fairly long time, which is what they intended to do if they spun out in a REIT.
One activist fund manager has suggested that in the new regulatory environment for REITs that operating companies should conduct IPOs as opposed to spinoffs. He noted that this approach could potentially be a template for monetizing real estate in the future. One example of this is MGM Resorts' recent IPO move. What are your thoughts?
I actually disagree a little bit with that, particularly as it relates to MGM. When the budget agreement came in place in 2015, we discussed earlier that it eliminated the ability to spin out real estate into a real estate investment trust on a tax-free basis. They grandfathered anybody who put in for a private letter ruling with the IRS prior to the date of the new budgetary agreement. MGM, Hilton is another very good example of this, where they had applied for the REIT spin-out rule to not be applicable to them and got grandfathered. So though that is a unique situation relative to MGM. I also think MGM doing it in the way that they are doing it is more an ability to allow them to continue to gain control by spinning out with a concurrent IPO as opposed to an outright spin out or a sale-leaseback. However, most commercial real estate, most forms of real estate are going to get greater valuation through an outright sale-leaseback, joint venture, or some of the other strategies that we talked about than a standalone REIT IPO like what MGM is doing. Again, I think MGM's strategies are more control-driven than valuation-driven, and those entities that are more valuation-driven, which is where activism plays into the equation, are more likely to just do a straight sale-leaseback.
Thanks so much. I've been speaking with Steven Goldberg of R.W. Baird. Thanks for watching. For more Merger Talk, visit The Deal.